Well, today we're going to talk about collateral protection insurance, or CPI for short, but I want to make sure that we get that out there. My name is Eric Hurst. I'm the COO of National Lenders and co-founder of the company as well. And we developed some programs and some products for the industry that are very exciting. But today, this is really about you and what CPI means to you as far as a dealer, as a lender in the buy here, pay here space. And we developed this presentation really to talk about, we call it the secrets of what folks see in this space. And as I go through various state association conventions and meet with dealers all across the country, whether it's somebody who's thinking about doing it or somebody who's been doing it for a long period of time, the one thing that I constantly hear from dealers that have been in the space now that I share with, if you're contemplating getting into CPI, is those that have been doing it for a while all say one thing: I wish I would have started doing it sooner. And after they took on the nominal amount of work that it is to put one of these programs in place, they recognize the upside opportunity. And there's some real reasons why we're going to talk about today. One, of course, is your portfolio protection, right? Insurance is an expensive adventure for consumers. It's expensive for all of us. We all buy insurance and we all recognize and have had to absorb that increasing cost. For a lender, for a buy here, pay here dealer, it creates an operational efficiency, however. Through that operational efficiency, what you don't have to do is sit there and track a lot of insurance on a regular basis now, because you're bringing folks into your CPI program and you're bringing them into this force-placed insurance product. And quite frankly, your customers are happier because of it, but it's also creates a lot less work because now you're not tracking all of your insurance policies on a regular basis. Your collectors are not focused on tracking insurance. They're focused on collecting payments. They're not focused on calling customers about insurance and, working for one of the other insurance carriers in the marketplace, trying to get them to go there and give that money away. They just focus on having that money come back to the dealership. So they're not working on a counterintuitive project. And of course, for many dealers, whether you bring this program in as a reinsurance program or a retrocession, if you agree to take some of the risk, you get all of the rewards. So you create a new revenue stream. So this product brings money to a buy here, pay here dealership, right? Your investment, your outlay is nominal, if any, but your outcome is new money. Some examples of millions of dollars a year, depending on the size of the opportunity. And of course, you have some improved compliance benefits to the program as well. Those can range from working with your clients to give them proper notice and take that notice to those folks, let them know that you're going to bring them into this program. You can either do it in some states point of sale and advise them that they're going to be enrolled in this program rather quickly, or in other states you have to provide notice, depends on where you're at. Certainly you want to talk with your provider that you choose to bring into this space and what that really looks like for each one of those. The revenue potential is it's beyond real. I made the comment that I wish I would have started it sooner. I wish I would have done it sooner. What a lot of folks recognize is the potential back end income from this program. So as you bring your clients, if you have a 1,000 accounts in your buy here, pay here portfolio, there's a good majority of those that do not have standard insurance through, one of the regular companies, all State Farm, General, et cetera, all those companies that you all know the names of that you see certificates come from. The vast majority of them won't have that insurance. So you'll bring them into this program. And CPI is not just about protection, it's that income generator for you. So as those premiums are paid, they ultimately get cycled back through that retrocession or reinsurance program to you. But the cost of insurance has increased, and that's where this gets really interesting. As I travel all over the country, I talk to folks who are maybe not familiar with CPI or not as familiar. Some haven't even heard of it yet. And we talk about insurance, and that is the pain point that if you want to talk about the common bond amongst all 35,000 used car dealers in the country, that's one of them. This chart, from 2021, the cost of insurance has increased by 38%. But if you look at that blue line, that's your customer's wage line. It hasn't increased. So it got increasingly more difficult, right? We also heard the price of eggs going up, so did everything else. The cost of insurance went through the roof, and your customers cannot afford that. So guess what they did? They let their insurance lapse. It went away. And when that insurance went away, it became more paramount for dealers to get involved in these types of programs. We had a dealer that signed up with us a few years ago, had never been doing CPI, had not done CPI in the past, had good sized book of business, and finally decided, hey, let's go ahead and start the program. Today they bring in over $135,000 a month in premium. They have net retained earnings of almost $1.3 million because they agreed to take on some of the risk of the program. So they've increased their bottom line. That equates to about 20% of their bottom line on an annual basis. That went up with real cash, real dollars, real money, and it's real money that's collected up front. Again, you can pass those funds through reinsurance, or you can pass those through a retrocession program. How do you decide if you're ready for a CPI program? That's probably the biggest question I get asked by anyone is I don't know if I'm big enough. I don't know if I'm ready. I don't know if I should. And generally, I sit down with a dealer and he says, hey, I'm small. I don't know if I should do it. While there is a threshold that makes certain sense for a lot of folks, we go down the path of whether you want to consider CPI with or without reinsurance. There's a cost to set up a reinsurance program. And for a smaller dealer, there's a break-even point. So if I'm a dealer that's sitting there with 150 or 200 accounts on my book of business, that may not make sense for me to go ahead and set up a reinsurance program right away. So I may talk to my vendor, my provider about setting up a retrocession program. While those funds, those profits, those returned underwriting profits come back in as top line profit to the dealer, you still have advantage of making more money off of this program, which is very advantageous for any and all dealers, right? Anybody. I mean, if I could see you all, I'd ask you for a show of hands who wasn't interested in making more money, and I don't think anybody would raise their hand because I've just not met that person yet that doesn't want to make more money in their business. It's what we strive for. So if you're ready to invest in this long-term tax advantage strategy, then you would want to set up a reinsurance program. And the provider and there are a lot of good providers in the space, equally qualified to provide good information to you that will all take you down this path and take you through these questions. But for yourself, you just want to understand if I'm smaller, I probably want to work with a retrocession program. There's probably not a break-even point to set up a reinsurance program for $4,000 or $5,000 a year. I'm probably not going to get enough profit out of the program to absorb that cost. I won't have the tax savings. It won't provide me with the tax benefits as if I were doing large amounts. Now, if I'm sending in $50,000 or $60,000 or $70,000 a month, almost absolutely you want to be into a reinsurance program at that point because there are some significant tax benefits for you and tax deferral programs that you're going to want to talk with your accountant about and your provider, your CPI provider or your reinsurance provider about how those programs can benefit you. But we have a lot of folks, probably 50% of the people that we do business with, they don't do reinsurance and the other 50% do, and it's all based on volumes. So a lot of folks ask me what happens, how does it work? What happens in the process? And this is somewhat of a universal concept is the lender is the insured. So the lender gets issued a policy and then they bring in their consumers into the policy as they don't have insurance, their insurance lapses. However, they get notified that that insurance is no longer there. They bring them into the program. And so XYZ dealership, XYZ RFC, XYZ lender is the insured. And you force place the policy, you go into your system depending on who your DMS is, and you enter that into the system and say, hey, okay, yes, I've got CPI on there now, and there's a CPI payment that's determined by yourself and it's determined by the insurance carrier, the provider of your program, and you determine. And in almost all cases, I've not seen it where it doesn't exist, so I can't say for sure, but in almost all cases, I'm sure of it, you're able to divide that insurance premium based on the frequency of your payment. So you're not creating new burden for your customers from a timing standpoint. So if you're collecting biweekly payments, you're also going to collect this insurance premium on a biweekly amount as well. And then at the end of the month, you remit those premiums to your carriers. So you have the use of that capital all month. So there's an opportunity for some arbitrage up front while you're sitting and camped out on that cash as it's coming in. And then at the end of the month, you go ahead and pay those premiums over to your provider, write the check for the premiums that were collected, and the insurer receives that premium, right? And then typically what they'll do is they'll deduct any claims that you've had paid out of your reserve funds and rebalance your reserve. Most of the providers will capitalize a reserve fund for you and pay claims directly. In insurance, it's kind of a weird thing. There has to be true transfer of risk, and then premium actually has to transfer from you to the insurance provider in order for it to be a qualified insurance program. So those are some things that are kind of interesting in the marketplace to make sure that you look out for as you're talking to different providers, that you're actually paying the premium, that those insurance carriers are actually paying some of those claims for you, and you're not just funding all of those directly out of your reinsurance account directly, because what happens is you lose track of some of those claims processes. Then the insurance carrier submits back to you or submits back to their reinsurance carrier, which ultimately ends back to you. The insurance provider is responsible for collecting premiums, paying all the premium tax in the states that you are in, whether you're in the state of Florida or any other state in the country. The provider is responsible for that. And then they cede 100% of that remainder. So premium minus any commission fees or administrative fees, minus any other claims to rebalance your reserve accounts, and then that money ultimately ends up back in your hands. So that either goes to their reinsurance company that ultimately has a contract with you, or your reinsurance company, or a retrocession agreement, and those funds go back to you. Typically, those companies are either a tribal-based company or some sort of maybe a Turks and Caicos seems to be very popular these days as well. So with or without reinsurance, talked a little bit about how size has a tendency to dictate whether you should or should not, but there's pros and cons to everything, right? So, and it doesn't matter how big you are. We've had clients come on board that, I mean, I have clients that are sending in $900,000 a month in CPI premium, and they do not have reinsurance companies set up. And they've opted for that for reasons either because they have multiple owners in the company, or they don't want the money to leave the company. They have other financial investors, and those investors decline the ability for the money to actually leave the organization and pass through these reinsurance entities, and they want it all back as a retrocession agreement. So the business goes back and signs a retrocession agreement with our reinsurer, typically in an offshore tribal situation, and they're allowed to do that because those are the laws and the rules that are provided within that country and that setup, and they're allowed to reinsure without reinsurance licensing. But you have this lower initial cost. So if you set up CPI without reinsurance, you technically don't lay out any money up front. So you just begin the process of force placing your insurance, finding all your clients who don't have insurance, and sending out the notice saying, "Hey, guess what? We now have put you on this program, and send us the extra $75 every 2 weeks," or whatever that amount that you've arrived at is. And the vast majority of those customers call up and they're happy about it because they've been wondering why you didn't, or wondering when you were going to come repossess their cars because they didn't have insurance. So, scary situation for them. You've solved their problem. You've created an opportunity, and you've done something for your clients, and that's important because I want to touch on that just for a second. In this space, it's really important to remember that you're doing something for your client. You're not doing something against them. They're as scared about not having insurance as you are about them not having insurance. You have to keep that in mind. But they don't have a solution, and they don't know what the answer is. And you've provided that solution for them. So instead of creating a bad situation, you literally have gone to them and said, I'm giving you something that you otherwise weren't able to obtain. And in almost all of the cases that we found these days, their CPI premiums are common sense and reasonably priced, that they can actually afford it, as opposed to being able to afford premiums through the traditional marketplace. We create simplified operations and cash flow flexibility. Those are some pros without reinsurance. You don't have to worry about accounting processes and procedures for reinsurance. You don't have to worry about the remittance and or managing reinsurance companies on the backside. But you have some limited financial leverage, and you lose a little bit of control over claims process at times. There is no tax benefit. There's no tax deferral benefit when you don't have a reinsurance company. If you think about the pros with reinsurance, right, which answer the opposite, is I get a tax deferral program. And what that means is those premiums, if I've set up a reinsurance company, instead of that money coming back to my top line operating profit of my business and contributing to my overall EBITDA, which is subject to tax under corporate tax rates or pass-through rates, depending on how you're set up, I now have a tax deferral. So that money left the company and it went into the reinsurance company that you now have set up. And that reinsurance company is allowed under an 831B election to park that premium for a long period of time as long as there's continued risk. And you don't have to pay taxes. There's the ability to take loans out. There's the ability to use that money for capital investments, to make more money with it, et cetera. And you'll have an accounting firm that prepares a tax return for your reinsurance company every year, as well as setting up and renewing the reinsurance licensing for that company. All things that you're going to want to talk with your accountant about what the best strategy for you. But one of the cons, of course, is there's a cost. I've seen anywhere from $3,500 a year to set up reinsurance companies and do tax returns. And I'm seeing less of that $3,500 a year these days, and I'm seeing more in the 4 and 5 and 6. And I had somebody quoted the other day $7,500 a year, but they had some additional benefits. So the price for reinsurance can vary widely depending on what you want out of the program and what you want that manager to do and what you want that accounting firm to do for you. Certainly, it's enhanced profit potential for whether you do it with reinsurance or without reinsurance. You are absolutely going to make more money off of this program, and you're absolutely going to bring more money to your bottom line. With CPI and with reinsurance or any reinsurance program that you may consider, you want to have a long-term vision. You want to have something on your horizon. You want to be able to think and forecast out a little bit because it comes with exit strategies. You have to think about reinsurance. You don't just wake up one day and say, okay, I'm not going to do reinsurance anymore, because you may have $3, $4, $5, $6 million accumulated or over the years in reinsurance, and whether you've taken some of that out as loans or whatever. Now, as soon as there's no risk, those funds are now subject to distribution. You have to take distributions and you have to pay tax. So you want to have a good, clear picture on what your future is going to look like and what you think that future is going to look like, so that you can make certain strategic moves with your reinsurance company well before you decide it's time for retirement or it's time to sell the business. These are living, breathing corporations. They're entities, and they require you to spend time managing it. So it does create some administrative burden for you. But certainly for those that are putting, 20, 30, 40, $50,000 and up a month into these programs, that administrative burden is often worth it, because now you're deferring off roughly a 30% tax liability. So on a $100,000 profit, if it's straight away and makes it all the way to the bottom line, you've got a $30,000 tax deferral for the year. So it matters. It's relevant. So all things that you want to talk to your provider about. Like I said, there's some great folks on this call. There's some great folks around the country that can talk to you about the same thing. Excuse me one second. Well, secret number 6, and this is something we talk a lot about, and that's tuning up your reinsurance program. So some of you may have reinsurance programs established, and maybe you're not even in the CPI space, or maybe you're not even in the buy here, pay here space, and you tuned in to think about or hear a little bit more about reinsurance. This is a corporation. It's a company. It requires you to look at its expenditures, and it will have expenditures. It should have expenditures. It's a corporation. It has risk. All the premium that you put into that reinsurance company is either earned or unearned. Okay. And you're constantly seeding new risk to it. What gets missed is reinsurance company expenses. One of the first things that we talk to folks about are their session cost or administrative fees related. And I say this because we all wake up at the end of the month or the beginning of the month, and we look at our financial statements from the previous month, and we start looking at our expenses. And gosh, it seems like advertising. That's the seems like the advertising budget is always the sacrificial lamb when somebody's looking to trim expenses, because it's usually the first one on their list, because administrative fees don't show up, right? Administrative fees for your reinsurance program don't show up. And most folks don't look at a financial statement for their reinsurance company on a monthly basis. They might just see it once a year, because a lot of times it's just a set it and forget it environment, and they don't think about it. And all of a sudden you look at, I saw a financial statement not too terribly long ago, and I asked the folks I was working with, I said, so you've put $1 million into your reinsurance company, and you've paid $200,000 in administrative fees for that $1 million, right? So if your tax savings you thought was 30%, you have a 10% tax savings, you'd have been better off passing that money through to your top line, because your administrative fees consumed so much. You paid the tax up front, whether you realize it or not, in administrative fees, and you still have a distribution level capital gains tax due when you decide to take money out, that's going to come in somewhere around 22, 23%. So your effective rate was 43%. You could have just paid the tax at 30 and you'd be 10 points ahead. Scratch their head. I said, gosh, how do I fix that? I said, well, first of all, you have to pay attention to your administrative fees for your reinsurance company. You constantly have to negotiate those with your providers. It's a competitive space. We're constantly having those conversations, as you should with anything in your business. Constantly examine your vendors, constantly examine what's happening in the space, constantly examine what you're getting charged for and how much money you're spending for anything. This is no different. So technology has been somewhat of an interesting environment in the CPI space for years. When safeguards went into effect a few years ago, it forced a lot of you to engage with a company that helps manage your security. And I get from a lot of my clients, I've got to do a attestation that we're PII compliant, that we're providing a technology, that we take classes for security breach, that we go through a number of these things, and we do these things as a vendor because I have an obligation to protect data that you send to me. Whether it is or isn't PII compliant, we do it anyway, and your vendor should do it. And they should have any type of notification, lapse detection, safeguards data. They should be able to create attestation documents. They should be able to provide you with SOC audits, SOC type 1 and type 2 audits, so that you know the data that you're providing them is secure, and it is coming in a secure method. I'll give you a pro tip. If you're sending your data in an Excel file in an unencrypted email, you broke one of those rules. Don't do it. At least get it into an encrypted email. Better off to lift it to a secure portal. Your vendor should have a secure portal for you to take data to, that is, I don't want to say unbreachable, because I don't think anything's unbreachable in cyberspace these days, but certainly protected by significantly greater security enhancements, and that it's not just flying through some email system that somebody phished your email and somehow is cloning, or being able to see your email. So be very careful about that. Portal to portal is the best. One of the things that I know that we did directly when we began investing in these platforms was to create that direct portal. There's no human intervention. Anytime somebody gets in the middle of something, it's the opportunity for a breach. So you want to cut down the number of hands that are actually touching your data. Get as many people out of the middle of that process as you possibly can. Nothing's foolproof these days, I don't believe, but we have a vested interest in making sure that we're doing all the things. And you should ask your vendors if they're following safeguards protocols, and you should ask them if they're using SOC compliant and or audited systems. And by gosh, ask for a copy of the audit. We keep them on hand, and anybody asks me for them, I give them a copy. It's a pretty big one. It's quite long, so enjoy the reading if you're so inclined. And then, what does the wrong thing do, right? I don't think I've met anybody in business that's been in business for more than 10 years that hasn't had an experience where they set up the wrong program, had a provider do something they weren't happy with. It just happens. It's just part of business. Doesn't mean you made a bad decision. Doesn't mean you did something wrong. You were relying on that individual to provide good information. But I can share with you this, at least as it relates to CPI. These are insurance products. The biggest question I see in some of the Facebook chat rooms. I see it frequently. I get asked on the street all the time, "Hey, why can't I just do it myself? Why do I need somebody to do this for me?" And the reality is, you more or less are doing it yourself, except this is a qualified insurance product. The states require a licensed insurance provider to issue the policy, to issue and take on the risk. Simply said, in insurance, if there's transfer of risk, the states independently require a license for that. That's the test, the barometer. This is one of those things where there is transfer of risk, so the states require an insurance. So I get the question again. Somebody says, "Well, why can't I do it myself?" It's a felony, plain and simple, in all 50 states for somebody to create and write an insurance policy and not have a licensed insurance carrier that's regulated and so on and so forth. As an insurance carrier, we go through extensive regulation on an annual basis where they come in and do audits and make sure that we're following rules and regulations and so on and so forth. And it's no fun. And we get it multiple times a year because we own multiple insurance carriers. And I promise you it's not enjoyable, but it's just what you do. We talk about compliance is not an option. It never is. If you're not compliant, it's wrong. And there's no in between. There's no halfway doing these things correctly. So if I could emphasize one thing, if I could make one point, it's CPI has to be done through a licensed insurance provider. And then in most states, have a requirement that that provider is admitted within the state or that it is a licensed surplus lines carrier. There are not too many that I can think of actual surplus lines insurers that are in this space because it's readily available. So you're not gonna find a surplus lines insurance carrier writing this type of product within the U.S. If you do, you need to question it because I have a duty or responsibility to seek out an admitted carrier as a surplus lines writer, and the only time I can actually use a surplus lines insurance provider is if one's not available, and they are available in all 50 states. So keep that in mind. It's a question that you're going to want to arm yourself if you're considering this. You want to ask, is this domiciled in the US? Is this a carrier that's admitted or authorized to do business in my state? Are you paying, does the carrier pay all the premium taxes, or am I responsible for self-directed self-procurement tax? That's a big one these days. I've seen it a couple of times. You want to avoid legal and tax and regulatory exposure at all costs, right? None of us knowingly want to wake up and make a bad decision. And if you do wake up and decide to make a bad decision, you at least want to know that you were doing it, and you want to be okay with what your consequences are if you decide to roll the dice that way. And ensure that you give proper disclosures. Most states have a lot of states have some kind of CPI regulatory language around it. And for those states that don't, the CFPB takes over. And the CFPB does have specific language. One of the rules that we all have to follow, no matter who we are, where we are, is a notice has to be sent to your consumer. Some states require notice ahead of time. Some states require notice after the fact, but all states have the after the fact notice. So you want your provider to send those notices out, even though that's your responsibility as a lender, it's your responsibility as the owner of the RFC. Ideally, you want your provider to send that notice out to your consumers. It has to be sent regular mail within 30 days. You want your provider to provide copies of those notices to you, either in print or in digital format. You want your provider to be able to record the postage for those mailings for you. You really want to have somebody that's got your back in these programs, because the last thing you want to do is get a stack of mail that says send these out, right? Um, could potentially be a recipe for disaster, especially if it doesn't get sent out timely, because they have to be shipped in 30 days from the time that you actually force place the program. So questions for you to ask, questions for you to arm yourself as you're talking to folks and you begin to shop these things or think about these programs. And the last thing that we're going to talk about is just that evaluation, right? Consider your, as a recap, consider your loan portfolio, right? Consider your risk tolerance. You have to have a little bit of risk tolerance in this space. You, frankly, if you're in the buy here, pay here space, you've got a high risk tolerance and you're already taking the risk whether you like it or not. Because if you have customers that don't have insurance and you don't have a CPI program, you already own the risk. If they total their car, we all know how that ends. They stop paying and you're writing off the loan balance, right? And maybe you do, or maybe you don't have something that you do with them later, but you've already taken the risk. So the reality is you already have the tolerance for it. Compare costs and administrative fees. Those are the things that cost your reinsurance company money. That's the difference between you making good money and a lot of money, right? That's that good and great concept. And then you want courteous and timely notices. We talked about that. And you want somebody who acts promptly with proof of insurance notices. If you get cancellations and you're doing your own tracking at the lot level or at the RFC level, you want to make sure that you respond to those quickly, put those in your system, add that CPI program to your account immediately, and get that data transmitted over to your provider so they can get those notices out for you. Typically, your provider will either pick up notices, they'll pick up your data file once a week, once every 2 weeks, or sometimes I've seen it done once a month. You ideally want it done mid-month and end month so that the notices are timely. Think about this. If you force place somebody on the first of the month and your provider doesn't pick up your data file till the first of the following month, you've already violated the law. Understand, it's not the provider's responsibility to send those letters. It's a courtesy that we do in many cases because we want to make sure that we protect you in the program and make sure that you don't have any heavy lifting to do. And that's one of those burdensome items. It's one of those tasks that often doesn't get done. You want technically enhanced programs and platforms because there's a lot of data that's stored with respect to insurance and VINs. You want to be able to go in and create quick claims processing, and you want your claims paid very, very quickly in these programs. So having an online portal to enter claims into and your provider decisions those claims very quickly for you, typically within that day or the next day, because you've already done most of the work with providing repair estimates and pictures, and you have a pretty good understanding of whether or not that car is going to be able to be repaired, or that you even want that car repaired under one of these types of programs, or if you're looking for that car to be a total loss, and then ultimately that claims adjuster, I won't say agrees with your assessment, but certainly evaluates the assessment and agrees with what your assessment was and provides either that total loss or that repair estimate, that repair bid. Reputation and compliance, you have legal formations to be concerned with, certainly transparent pricing. This is a very competitive space these days, and, make sure that whoever you're talking to, that they itemize every single penny. If you're getting charged for assessments on vehicles, if they're sending out inspectors, you want to know what those charges are up front. You want to know what your administrative fees are. You want to know that the taxes are being paid. Ask for those confirmations. You want fair and timely claims handling. And when I say fair and timely claims handling, you want your claims paid typically inside of about 48, 72 hours max. Time is money, right? And the faster you get those funds back for those repairs or those total losses, the quicker that money's back in your hands out of your reserve account. So you want that done fast and quick so that it happens and you get maximum arbitrage on any interest funds that you might get while you're sitting on that capital waiting to pay a repair bill or waiting for that consumer to decide if you're going to put them in another car or not. Either way, you've got to do something and it should happen quickly. You want to ensure that your providers are giving you good training and good support. Certainly, it's our job to make sure that we help you avoid pitfalls. It's our job to make sure that we're providing you good talk tracks, best practices that work for some of the most successful dealers in the country, things that we've seen that have helped, things that we know that work well, and of course, making sure that we provide you with as much information to avoid pitfalls as possible. I always recommend that if you have general counsel, that you seek some advice for any programs, and as it relates to financial data, you always seek the advice of your CPA before you make any of these moves. But make sure your program consists of quality follow-up and quality support at all times. So, yeah, first steps, right? Pick up the phone and call somebody and ask the questions, right? How do you manage your cash flow? How do you manage administrative fees? So you've got to take some action if you're in a program. If you're considering a program, certainly reach out. We're happy to answer any questions and help you with any type of guidance along the way. I want to thank the FIADA today for putting on this presentation and allowing us to present it. And we certainly look forward to seeing a lot of you at the convention coming up here just in a few weeks. So make sure if you haven't registered for the Florida convention, please do so. We do have a booth. Happy to answer any further follow-up questions. I know we had this session slated for 45 minutes. We're actually at 37, so I finished in just enough time for us to get any questions. So I see that we had a couple questions about whether or not this was recorded. Jennifer, I don't see any other questions in the chat box.
It's in the other section that's called Q&A down along the bottom. Karen had a question.
Oh, okay, hold on, let me see here. Q&A, okay, so I see one question, ask for a recording. Yes, open question. Can you recap for a few who joined on late? What is CPI? Thank you, Karen. CPI is collateral protection insurance. Collateral protection insurance is not actually an insurance policy. Collateral protection insurance is a form, a name, a creation. It's a pronoun for a program that dealers actually apply for and get insurance products that they can force place for their consumers that no longer have insurance in the space. Good question. Thank you, Karen. Does anyone else have any questions?
So there's another question if you go back.
Oh, I gotta learn my technology here, don't I?
Go back to open.
Yeah, I got it. If you're currently with a company currently, and we want to switch, is that a big deal? Generally speaking, it's not. Generally speaking, it's pretty transparent. Everyone in this industry that I'm aware of pretty much does the heavy lifting for you with regards to the process. So unless there's some interesting things related to your program, depending on how your reinsurance program, or if you have reinsurance set up, depending on how it's established, that might be a slight sticking point. That's the one that takes the longest. But this is it. Effectively, we're issuing an insurance policy. We can issue the insurance policy in a matter of days. Transitioning your clients, your new provider sends out letters to those clients saying, hey, now it's with this company versus that company. It all gets done for you. What do I often tell somebody who's in a program? It's really for you as the consumer of the product, as the insured, as the RFC. It's the difference of, instead of writing your check to company A this month, you're going to write it to company B, and everything else that was involved is effectively handled on the back end for you. Everyone that I know of is equipped to manage that transition pretty seamlessly, and most do a pretty good job that I've seen. I wonder, how do you calculate charges for the customer for CPI? Your insurance carrier typically does that for you. There's a couple of things that are related to CPI. Typically has a lot to do with your ACV. If you think about it as a market calculation, you're trying to run somewhere between 12 and 15% of what your ACV is. If your ACV is north of $12,000 on an annual basis, divided by 12 typically covers the risk. And then, of course, the size of the portfolio and how much risk you're willing to take on. So if you've got 1,000 customers or if you've got 10 customers, that matters. But they'll work with you as far as assessing that number. So again, Usually what you'll see for premium base is somewhere between 12 and 15% of the contract of the ACV of the contract balance, which is an annualized number divided by 12. And then typically we have ACVs that are under $8,000, that number usually ends up going north of that because the repair cost and the severity of each one of your claims, you're going to end up with 99% of your cars are going to be total losses. So you typically up that premium amount because it doesn't take much to get a $5,000, $6,000, $7,000 claim in the repair business these days. If an airbag went off and it was a $7,000 ACV car, I mean, almost all the time it's a total loss. You're going to be replacing the car with the consumer. I wonder if my current program is overpriced. I do too. You can call, and you're happy to call. My information's on the screen. You're happy to give us a buzz, shoot an email. Depending on what you're getting out of the program as to whether or not it's overpriced. Not everything's apples to apples. Taxes are different in each state, so there are variables that matter. I could have two dealers with identical sized portfolios, and one's getting charged one price and one's getting charged another price. A lot of that has to do with the premium tax that's assessed by the state, right? There is no one size fits all across the board. Every state has a different tax rate for insurance carriers, and that obviously that tax is absorbed out of that premium. It's typically absorbed out of that administrative fee, and that usually is a driver of what's priced. And then if you've asked for additional products or services in it, you might be asking for tracking or types of things, other mail or notices, or you've asked them to provide some technology. So there's variables in the programs. Happy to at least share. If you want to give me a call, I'll certainly share conceptually what we see as far as that goes. Is that the reserve amount? Karen, I'm not sure where I might have left off of. Is that the reserve amount? We were talking about premium calculations. Reserves, typically, I'll just define, and this is to a certain degree somewhat common across the industry. Most carriers have some sort of reserve calculation that typically ends up with the average premium amount for the last 90 days. There's an annualized calculation of 8.5% of the last 12 months worth of premium. For a client who's just getting into the process or just getting into the program and they've never had CPI, obviously there's no premium to calculate reserves from. So there's usually a minimum established at that point, which is a byproduct of how big the portfolio is, what the expectation of that portfolio is, and then that reserve set at a low point and continues to grow as that pool or those funds that are coming in from the CPI premium increase over a period of time. Generally, that reserve increases because the risk is continuing to go up, and the likelihood or propensity of claims obviously increases as it increases as well. Well, fantastic. Great questions.
Eric, there's one more good question if you have time for it.
Let's see if I can scroll down and find it.
I actually have a couple too. I'll make it quick.
Okay.
Though.
Very good. No, that's great. What count of vehicles do you recommend that's worth to start CPI? If you have 100 loans on the books, it starts to make sense depending on what your ACVs are. But at 100, it starts to make sense. We can make it make sense with less if you're sitting on higher ACVs at times, but because you're taking on some risk. I mean, honestly, if you had 10 loans on the books, it makes sense to do CPI programs, but generally it might not make sense for you to go through the headache and the hassle of it is what it really comes down to. At any point in time, you're obviously collecting. If you're not enforcing outside insurance with your clients, and go back to the 10 account example, if you're strictly enforcing that they have to have insurance, and if they don't have insurance, you go pick up that car, CPI makes no sense for you. Okay. If you have 10 accounts on the books and you don't enforce CPI, but you sure would like, or you don't enforce insurance rules and you sure would like that for them to have insurance, but you're not enforcing it, quite honestly, if you assessed a CPI program on 10 units and you were collecting an extra $1,500 a month, that's not enough to pay off one of your cars. It's not enough to pay on a claim, but you've already agreed to take on that risk. So it's $1,500 that you didn't have before, that you have now. So there's a couple of ways to look at it with regards to that. Not advocating that you set up CPI with 10 accounts, but I kind of understand the concept. If you're not forcing a client to pay or to get insurance, and you're not doing that, then really there's no minimum for you. There are a lot of providers that won't set it up that small because the amount of labor and effort that goes into it's not really worth the amount of return for a lot of folks. So you might be hard pressed, but usually about 100 and up, you'll start finding some interest in it starts to make sense for you.
Is that all we got for now? Okay.
There's a couple more here. There's yearly costs with your program. Again, varies whether you're doing reinsurance, not doing reinsurance. Typically works, there's administrative fees that are centered around what state you're in, the tax base. So it's really hard to give anybody a specific number without understanding what state they're from. I know we've got folks that are typically from multiple states on here when I looked at the attendee list. So I don't know where exactly you're from to be able to say that, but it's anywhere from 8 to 10% typically, and then plus whatever the tax rate is what we see as far as going market rates, and that's of the premium. That covers claims administration. It covers all your letter mailings, etc. And Nori says, no question, just a comment. Thanks for all the great information. We'll be sharing with your dealers. Thank you, Nori. We appreciate you for that as always. Jennifer?
Okay, so those were all really good questions, by the way. And I don't have anything that complicated, but for everybody on here, obviously it's being recorded and it will be in our info hub for our members. So I had a couple things come to mind, questions that nobody asked that are on a very basic level. But I thought it would be nice to have it on the recording since nobody brought it up. The first thing was, I'm assuming that you guys integrate with all of the DMS providers.
So whether it's an integration or a flat file setup where we grab SFTP setup, the answer to that is yes.
Okay. And then my second question was, when you go, let's say you have a customer that you're going to put this on, is there a notification? Is there an amount of days that you have to notify them and say, hey, this is what we're doing? Is that part of the process?
Most states, there are a few states that require notice ahead of time. Tennessee is one of them that comes to mind off the top of my head. Karen's on this call. Most states don't require notice ahead of forced placement, the 24 hours that if the insurance is lapsed for 24 hours, you're able to force place the program. There is a notice that goes on after the fact. That letter has to go out within 30 days. We were talking about, make sure your provider's sending those letters for you so that you don't have to carry the burden of doing that yourself. Those have to go out within 30 days. They have to go out first class mail. Okay. That's universal everywhere.
And a little side note to that before I get to my last question. Do you at National Lenders have something in place to educate and assist these guys with being in compliance with things exactly like that?
Yes, we do.
Oh, nice. Okay. And my last question is, when you, let's just say you do have an integration, Fraser, Dealer Center, whatever, and let's say I have a dealership and I go with you guys and I want to set this up. On my side of it, does that look like a side note that's not attached to the payment? Like when you pull up someone's account, it's like on the side where it's not accruing interest or late fees or blah, 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 blah.
Very good question. It is basically a side note that doesn't accrue interest, albeit a lot of laws actually provide dealers the ability to charge interest. They can only charge interest if they have a cash outlay. In these buy here, pay here CPI programs, there's no cash outlay, so they're not advancing premium. So there's nothing that they would charge interest on. So It's a side note that if it's give it simple math, it's $100 a month for the premium. They're just adding $100 a month to the payment, and then the frequency, whether it's the 216 or the 433 or the 12 or the 2, it divides accordingly.
Gotcha. Okay, I think that's all I'm gonna beat you up for now.
Sounds good.
For
Well,
answering
thank you
comments.
for everyone that joined. I appreciate it. And Jennifer, again, thank you for having us. We really appreciate it. And if we can be of any assistance, please don't hesitate to call us.
Absolutely.